Welcome everyone to today's webinar. Today we'll be talking about the numbers for decisions, understanding financials and collections. We have a jam-packed webinar here today. We do have the Q&A available, so either on the top right of your screen or middle, or towards the bottom, you'll have the Q&A option. So feel free to pose any questions that you have related to today's topic. We'll do our best to try to get to those throughout the webinar itself. If we're unable to get to them, feel free to reach out either to Donna, her team, or myself, and we'll be glad to answer any questions that are related to today's topic. So today, we're very excited to be on today's webinar outside of the topic itself, because we've received many emails asking us to do a webinar on financials and have a better understanding for both board members and managers and the importance of them. But more importantly is the powerhouse that we have here today, Joy and Donna Berger. Donna is one of the most respected community association attorneys in Florida. She's a founding member of the Becker's Community Association Law Practice Group and a trusted voice in shaping policy and also advising board members statewide. So welcome today, Donna, to the webinar.
Wow, thank you so much for a great intro. Thanks, Raphael.
No problem. My pleasure. Pleasure to have you. And I can't leave Joy behind. Joy is a collection expert who is guiding countless associations throughout difficult situations, whether it be financial challenges, clarity. She has a proven strategy to it. So we're super excited to have you on for the first time, Joy. So thank you for joining us.
Thank you so much.
Excellent. And myself, my name is Rafael Aquino. I'm the co-founder and CEO of Affinity Management Services. We're a community association management company. Our core focus here and our passion is really helping community association leaders execute their vision. So we're excited to jump on today. And I know Donna kicked it off. Like, I'm going to be handling a lot of financial questions, but we'll be going through the process and understanding a little bit of what board members should be cognizant of throughout their journey, and especially with all the projects that we have going on, both in HOAs and condos and all the legislation. So I wanted to start off, I guess, with the first question, Donna. I'm going to kick this off to you. And if you could give us a little bit of an understanding of what are some of the key components for financial reports and what board members should be focusing on when they're reviewing those financial reports.
Yeah, and thank you. And I do want to say for those in attendance, for the purposes of this webinar, Raphael, Joy is the powerhouse on this. I am kind of the afterthought here. I'm the transactional attorney. Joy oversees collections for thousands of associations throughout Florida and in some of our other offices in other states. So I'm going to be deferring to Joy a lot. But you asked me about financial reporting, and I actually did a little deep dive into this topic. I think, first of all, that board members, you said, what are the key components of financial reports? First of all, I think that board members should not get hung up just on the numbers, okay? They should focus on trends and indicators of risk and opportunity. So I'm going to run through them, but I would say for our board members a couple things. One, when in doubt about what you're reading on your financial statements, ask the manager or an accountant for context, okay? A lot of people like to be their own specialist, but in this regard, really ask somebody to walk you through it. Don't make assumptions. The other thing I would say is it's important for every board member to look at the financial statements. Don't just leave it to the treasurer and the manager or the president and the treasurer. It's really incumbent upon every board member to know what you're paying for insurance, for example. I had a board meeting recently and no one but the treasurer knew what they were paying for insurance. So what should they be looking for? What are the key components? One is the balance sheet. So that shows the association's financial position at a specific point in time. It shows your assets, which are cash, receivables, reserves, and other property, the liabilities, which are unpaid bills, loans, or accrued expenses, and your net worth, your equity or fund balance. What should you be looking for? Basically, any red flags like high accounts receivables, which are unpaid dues. That's something Joy's going to talk about in a few minutes. Any trends in your reserve funds? Are they growing or are they depleting? Are we going to have time to talk about the bill that says you can invest funds? And maybe that's not a great idea right now. We'll see what happens. Your income statement, profit and loss. That's going to show income and expenses over a period of time, monthly, quarterly, year to date. You're going to want to look, are you on budget? Are there unexpected spikes in expenses? If so, what's causing those spikes? Is the income tracking with projections? You'll want to look at a budget comparison report. That compares the actual income and expenses to the adopted budget. Was your budget wildly off target? Right? Do you ever have that
Hmm.
happen?
Oh
I
my
mean,
goodness.
were they overly optimistic? Were they overly pessimistic? So you're gonna want to track that. And you want to flag any overages or shortfalls in specific line items. By the way, you can amend the budget if you need to amend the
Hmm.
budget. So accounts receivable and aging report, that's Joy's territory, which lists delinquent owners and how long payments have been overdue. What to look for, owners past 90 days due. Joy's going to tell you small balances are easier to collect, right, Joy? Than opposed
That's
to big
right.
balances.
Yep.
So you're going to want to be tracking that cash flow statement. It tracks the cash flow in and out of the association. And lastly, the reserve fund report. Oh, and the bank reconciliation report. This is really important. We teach at Becker a lot of board certification classes, and a big component of that is fraud prevention. So you're going to want to make sure that you don't have any red flags, any discrepancies or outdated checks, and that the association's books match the online bank statements.
Sure, those are great points, Donna. And I know, especially with what you mentioned earlier of understanding the trends. I think that that's where, many board members either just don't have the time or maybe education on how to be able to review it. But it's so important, especially when now that we're coming up on at the end of April. By now, you should have received your quarterly financials of your monthly, of course, and now your quarterly, and you should have a good idea of where you stand with your association. What has the first quarter looked like? How are we looking? Where have we potentially overspent? Where are we fine? What are the reasons? What were the challenges? And that way it allows board members to make a better decision and better understanding of what the rest of the year is going to look like. Do I need to do a potential amendment because I've gone over on X, Y,
Right.
Z? So that's why I launched a poll just to see, roughly where board members and managers are at if they've reviewed their financial statements. Because I know in my experience, especially when we're interviewing with new associations, when they have all these projects and we talk a lot about vision here at Affinity, and they have this vision of where they want to get to, but many times where they fall short is really understanding, do I have the money to be able to do a lot of these projects that I have in mind, that whether it be a board member initiative or whether it be a resident initiative, because if you don't have the money, there's no way anyone could be able to execute on that.
Oh, absolutely. Do you think it's the old ignorance is bliss kind of philosophy that some people don't really want to sit and scrutinize the finances?
I think so. I think so. I think many times they just, they don't want to see what's truly going on. And when you lift up the hood and you're like, well, I really can't do what I want to do. And it's a difficult decision for a board member to go to the residents to say, we need to increase the fees in order to do that, which is what needs to happen. I mean, look, I just ran the poll and quickly we have less than 50% of the individuals on the call have reviewed the first quarter financials. Good
Mm.
thing is that 100% have reviewed the monthly one. And on the financial management, well, that's good to hear that before starting projects, they're actually reviewing the budget. I know many times that doesn't necessarily happen. So, yeah, I do think, Donna, that what happens a lot is just they don't really want to know, or maybe they're just concerned to see what's really there. I wanted to ask you, when it comes to making those informed decisions, what's been your experience from board members in looking at those financial reports? Do you find it to be that they're looking at it, or you're finding that maybe they're not, they're just relying on the partner or management, or if it's self-managed on the accounting firm?
Yeah, I mean, like the example I gave, Raphael, if I'm sitting with a board, particularly now, so many of them are struggling with the SIRS
Mm-hmm.
funding, with the
Mm-hmm.
milestone inspections, with the insurance crisis. I mean, their budgets have gone up exponentially. When I ask them how many are really keyed in to the budget and the financial statements, again, very few hands go up. So that is part and parcel of the problem. I mean, if you want to govern responsibly, if you want to reduce the risk of mismanagement and fraud, then you as a board need to be operating based on real data, not
Correct.
guesswork.
That's right. That's right. 100%. And I think, especially with sometimes board members could get lost in the weed, and at least to look at the balance sheet. At least start with the basics. Do you have 2 months of operating capital in the bank? Do you have that? Yes or no? That's a simple answer, yes or no, at the end of every month. Where do you have your variances? So are you looking at your income and expense, and where do you have those variances? Why do those variances exist? Sometimes it could just be a misclassification. By mistake, we put this general ledger code rather than we put something in staffing rather than in maintenance. So it's truly understanding and just taking the time to look at that.
Oh, but
Being
may I just
sure,
add, I'm sorry, but
of
it's
course.
also important when you're tracking the amount of revenue you have on hand at any time, that
Hmm.
you may be woefully underfunded in terms of fidelity bonding. So
That's
I've
right.
been
Great point.
talking about those checks and balances to prevent fraud. We know the deadline to fund mandatory structural integrity reserve studies was 12/31/24 for
Hmm.
budgets. So any budget that was adopted after the end of last year, the mandatory SIRS goes into effect now. If you adopted that budget earlier and you waived it, then it's going to kick in 2026. But
Correct.
unless you have your eye on the revenues, you may not have sufficient fidelity bonding in place for everybody who's controlling and dispersing association funds. We are seeing fraud on the uptick.
Correct. Correct. No,
So,
that's an excellent point, and that's the importance of having that partner to guide you through that. And Donna, what are some of the legal responsibilities of board members when it comes to reviewing the oversight of the financial statements?
well, the statute doesn't say that you have to read anything other than you have to take a board certification class. But under 718 111 13, there are responsibilities to get the financial report done. So you've got within 90 days from the end of the association's fiscal year, and you're going to need to look at your documents to see if your fiscal year is the calendar year or something else, because not everybody's fiscal year is a calendar year, but you've got 90 days to get that report completed. Okay. And then after you get that report completed, you've got 21 days after it's completed, but no later than 120 days to get it out to everybody. Because one of the things that the Florida legislature also focuses on, that they're trying to focus on, is transparency.
Hmm.
That people living in these communities, they have a right to know how healthy the community or unhealthy the community is, as the case may be. Okay, that
Correct.
applies also to how structurally sound the community is. So board members need to understand that they have obligations, one, to get these things done, to make sure they're producing them in compliance with the statute, and to make sure that they're letting their folks know that when it's ready, and either sending out the entire report to them or sending out a notice saying it's ready. If you want it, we'll send it to you.
Yeah, great point. Yeah, the simple way I think, especially as a pro tip, is the postcard. Just sending a postcard. We have it up on the association website, and as you mentioned, Donna, there's been many changes with legislation for things to be much more transparent, which we're in total agreement with. You've seen the website requirements come down on the number of units, particularly for HOAs. So it's very important that you're putting that information out there, and also that you're receiving the information. You'd be surprised how many times when we're interviewing, there's not a specific date of when their financial statements are due. So that's one thing, at least for us, what we do is we guarantee when financial statements are going to be provided. And if that's missed, then we'll give them a refund, because that's our responsibility and that's how we hold ourselves and our team accountable. So if you aren't receiving your financial statements every single month by a particular date, you should be asking the question as towards why. And you shouldn't be more than, normally you'll receive, let's say, March's financials by 15th to 25th of the month, somewhere around there. And if you haven't received it, then you need to start asking the questions as towards why that's not happening. I want to bring Joy into the conversation with collections. I know we have a lot going on with structural integrity. We see it all over the news where they're discussing that many condo owners. I think there was an article this morning I didn't get to on the Miami Herald that was discussing of older folks really struggling to keep up with the new fees, especially for those associations that did pass their structural integrity reserves, and maybe the older buildings that they had years with no reserves, and now all of a sudden it's been an increase. So talk to me a little bit about what's best practice for handling delinquent accounts. I know you've been around for a while and you saw what we all went through in 2008. Maybe give us a little bit of what worked back then and what we need to be cognizant of today to, if should something like that ever occur again.
So I think that the biggest thing that associations need to be aware of or to practice is to be aware, right? To keep on top of your financials, because I think that back in 2008, 2009, all through that time period, associations simply were not prepared for the levels of delinquencies that they were facing. And it came about both because of bank foreclosures, but it also, so there were bank foreclosures that were happening to a much larger degree than they currently are. And as a result, a lot of owners were gone from the properties and no one was paying assessments. And I think that associations have realized that one of the best things to do is just to stay on top of their delinquencies, which ties right into what you all were talking about in terms of knowing what your financial state and paying attention to them. So the best thing to do is to have a collections policy where you treat everyone the same. So if you have quarterly assessments and you have a grace period for payment of those quarterly assessments, as soon as that quarterly grace period passes, which is usually the 15th or 20th of the month, sometimes it's the 30th for quarterly assessments, then you need to be sending that first letter to the owners, which needs to come from the association, that 30-day notice of late assessment. That's a new statutory requirement from a few years ago. And you need to make sure that you're treating all of your owners the same. So everyone is getting one of those when they fall behind. If you have monthly assessments, same thing. As soon as the grace period passes, you need to be sending that notice of late assessment and making sure that all of those owners can't say that they didn't know that they were delinquent, especially when they get turned over to the attorney. But if you do that, a lot of people, when they aren't set up on monthly or quarterly automatic payment of their fees, they may forget. It
Yeah,
truly may be that they forgot to send it
correct.
in. They may have had a habit of waiting until the second or third month of the quarter, if it's quarterly, to pay, or they may just have a habit of paying 60 to 90 days late in general. And the sooner that you let them know that you're not going to tolerate that anymore, the better. Because once they get that notice of late assessment, if they don't pay within the 30 days and it's turned over to the attorney, that's not a fun thing to get in the mail when you've got an additional $200 to $300 in legal fees added to your bill that you have to pay in order to stop this thing from moving forward. So the best thing that associations can do is just pay attention to their monthly and quarterly financials when it comes to these owners. Work with your management company to make sure that you have a practice in place of sending out those initial notices as soon as the owners become delinquent.
Yeah, I love, Joy, what you mentioned there of being proactive with the process and having, the policies, because I know when you don't have that, that's when you can fall into that selective enforcement where you're doing something for some and something for the other. The way that we have found for it to work is similar to what you said. It's just, having a process of, okay, if it's 30 days, the notices goes out a few days after that. And then what's the following process that the association is going to follow? Are they going to send it straight to the attorney, or are they going to follow, obviously, as you stated, what's within the document of what's permitted, I'm sorry, within the documents? Um, Unfortunately, what we do find sometimes is they wait too long. And they're just like, listen, they're a neighbor. I want to give them an extra month or two. And now I know we've seen a slight uptick, not a big uptick, but we've been seeing a small uptick little by little of the delinquency rates going up. I would say more on the condo side. I think it does have to do with the increases in fees. Um, but I know here we promote heavily of just, following whatever the documents state, because we went through 2000 and we saw the impact of associations in some instances having a 50-40% delinquency rate. And it's very difficult to explain to the residents why they're covering the other half when it's their responsibility, but there's not much that we can do. I did want to ask from your side, are you seeing a slight uptick on the delinquencies? And I'd love to get your opinion on, now that it's been a year since the NOLA letter, or maybe 2 years already, what has that caused any delays in the process itself, or balances to go up?
So we've seen more than a slight uptick. We've seen a large uptick in terms of delinquencies. I will tell you that in terms of the workflow in our office, from last year, the first 3 months of the year, we more than tripled the amount of
Wow.
accounts that we had coming into the office for collections. And with respect to the notice of late assessment, I'm glad that you brought that up. It initially when it was implemented, it certainly caused a delay in terms of us being able to proceed with collections, because our biggest goal is to make sure the association is protected. And the notice of late assessment is essentially a prerequisite for the association to be able to charge legal fees for a collection action. And so if that isn't done right, if that step isn't done right, then you can get all the way to the end of a foreclosure action and the owner may successfully defend against, the award of legal fees. So I will say that it's certainly gotten a lot more streamlined, and it's certainly gotten a lot smoother, the process of the notice of late assessment being sent. I will point out that one of the things that we still find is an issue is that sometimes associations don't send the notice of late assessment to all addresses that it should be sent to. And the reason for that is that the statute says that the association is required to send it to the property address, and it is required to send it to the last known mailing address in the association's records. We go a step further than that. We actually recommend that the association pull the property appraiser and the deed for that particular property, because oftentimes owners will either not contact the association with an alternate mailing address, or even worse, they will, but yet it won't make its way into the actual official records, or it won't be updated. So we just want to make sure that the association is protected as much as possible when it comes to those things. Other than that, that's really the biggest hurdles that we see, and those are easily fixable. We review all of that when it comes into our office. And I will tell you that many owners do pay from the notice of late assessment. So there's, frequently that's the way for associations to start getting that cash flow in, is just by sending that 30-day notice of late assessment and reminding the owners. But if that's done properly and you turn the account over, then of course we are then going to aggressively pursue collections for the association moving forward.
Yeah, and I agree with you there, Joy. I know it's been a little bit complicated from our side as well when, attorneys are being very proactive, and honestly, what you're doing is looking out for the best interest of the association before you get to a foreclosure case or to that point, and you don't have the proper notices, then all of a sudden, the association now has to bear this bill. So it has been a bit of a challenge from a management side because, we're hoping that the owners would let us know, and unfortunately they don't. So it has become a bit of a larger workload. And on the uptick, have you seen the uptick more on the HOA side or the condo side?
It's a mixture, but I would definitely say it's more on the condo
Yeah.
side. I want to circle back real quick, just since we're
Sure.
talking about the notice of late assessment. There is one other thing I wanted to mention, which is that because we're talking about, the SIRS requirement and the new addition or imposition of special assessments for a lot of those things, if you already have a pending collection action for an owner, meaning it's already at the attorney's office, if you adopt a special assessment during the course of that collection or even during a foreclosure action, the special assessment is considered something new and additional. It's not one of the regular ongoing assessments. And so you have to send another notice of late assessment just for that special assessment. So that way the owner can't argue they were never given the opportunity to pay that prior to attorney's fees being imposed. So I just wanted to circle back to that real quick. The uptick that we're seeing, it is primarily in condos, but it is in HOAs as well. I don't know if that's simply because, the economy is going through a little bit of a rough spot, or if it's simply because you've got investors who maybe purchase properties, and sometimes when that happens, they hold off on paying if they haven't been able to rent the properties out. But it is primarily in condos, yes.
Yeah, it's interesting.
Raphael,
Yes,
I'm
go ahead,
sorry,
Jen.
I had a question because this actually is very interesting. When you're adopting, getting back to the budget, what are you now including in terms of bad debt? Because I don't think any association can reasonably expect to collect 100% of all assessments. Correct? So what do you typically add for bad debt?
Right now, I would say as of last year, I don't have the actual data in front of me, but I know every year we do propose a bad debt. I believe last year we tried to push up to a 5%, but we did start to see. Normally, we would always say a protocol is 3%, no less than 3%, because you're going to have it. This year we tried to push up, especially on the condo side, just because we knew that things were going to get shaky, especially for those associations that were older. Prior to that, years before, obviously significantly much more, we would be able to have some data figures for each association to look back, okay, what did you have last year? Where were you at? And then, be very specific to the association. The truth is that we did get pushback because of the increases in insurance. In the industry as a whole, there's been increases in salaries as well. That's been the inflation the inflation impact for our associations, as well as cost on materials and so forth. So it's difficult for boards to swallow the entire thing of, well, I have my costs go up, I've had insurance, even though we had a little bit of a weakening there a bit, but we've also had salaries go up. So it was tough to say, okay, now we have to do bad debt as well. So I think that conversation is going to be a much stronger conversation this coming year, because as Joy mentioned, the economy, we do see it softening, and as soon as job losses occur, that's where you're going to see the impact, in my opinion, in many of these associations. And what legal considerations should the board members be aware of when they're pursuing these collections? I know you mentioned the notice of late assessment. Is there anything else that they should be aware of just to avoid any potential issues and ensure that the case moves forward?
So a couple of things that I would mention, especially with respect to the ledgers. The ledgers that we require from an association in order to proceed, they need to date back to or show back to a zero balance. Sometimes that's difficult for associations, particularly if they've changed management companies. So if you're in a spot where you're changing management companies, I would recommend that you either try to get those ledgers at the time that you know that you're going to be transitioning, or making sure that the new management company gets those from the prior management company, because the one thing we can't do is recreate what happened before, right? So sometimes we get these ledgers with a large forwarding balance and we won't be able to proceed unless we have backup documentation for that. The other things that I would make sure to look at are, again, you mentioned it before with the selective enforcement. Make sure that you're treating all of your owners the same. So if you are willing to waive interest and late fees for one owner in order to settle an account, then you should be willing to do the same for another owner who's in the same situation. I say same situation because that's important. Sometimes you'll have an owner who is a first time, delinquent,
Mm-hmm.
meaning they had not been delinquent before and maybe they fell behind. And then you might have an owner who is a repeat offender. They are constantly behind, they're constantly late. So you might want to have a policy that says, we will waive interest and late fees, the first time that you're delinquent. It doesn't have to be that rigid, right? But
Correct.
the point is you need to treat everyone the same, so that way you don't have those, selective enforcements. The other things that you really want to do are you want to make sure that when you're adopting the budget, that you obviously properly notice the budget meeting, so that way no one can claim that the assessments were not properly adopted. When it comes to adopting special assessments, you need to make sure that the notice of the meeting is sent out in the appropriate amount of time, which is typically 14 days, that the notice itself contains the information that the statute requires with respect to the estimated cost and the purpose of the special assessment. And getting your legal counsel involved at that point is a very smart idea, because they can really help make sure that that's done correctly and give you advice if you have questions about it. One of the biggest offenses that we face when it comes to collections is that the special assessment or the assessment wasn't properly adopted. So that's
Exactly.
really important. And then obviously making sure that you have a good process in place for accepting payments and putting them on the ledger. Sometimes we will have management companies who don't want to accept payments after an owner is in collections, which we never recommend. That can be considered a rejection of payment. I personally don't like it when the management companies turn off the ability for an owner to make a payment online, because I think that, one, getting money from an owner is what the association wants to do, right? And two, it can lead to the owner complaining that I wasn't able to make the payment, I shouldn't be charged the interest and the late fees, and there are ways that we can handle that. But you want to make sure that you have a process set up where, whether it's an online payment or whether a check coming into the management office, that those are things are being timely dealt with and deposited, so that way they're appearing on the ledger. You never want to have a situation where a check is being held and not deposited and credited on the ledger, because the owner can then raise, issues like that. And then obviously you don't want to be talking in the community about delinquencies that you have. When you have these board meetings and you're talking about, you can certainly talk about, we have a 3% delinquency rate, or we have 10 homeowners who are behind on their assessments and the attorney is dealing with that. That's fine. But what you don't want to do is mention names, mention amounts, unless you're talking about a total amount, and if you do have to discuss specific owners at a board meeting, then you only want to reference them by their property address, essentially. So you don't want to run afoul of the Florida Consumer Collection Practices Act, which as an association, doesn't allow you to publish a deadbeat list, doesn't allow you to defame or, talk negatively about owners. You're not there to shame them. You're just there to this is a business from that perspective, and you just want to proceed in collections the way that you should. So those are some legal things that you really want to pay attention to. And you also want to make sure that when you are discussing collections at your board meetings, that you're voting on whether to proceed with, collections, foreclosure. And a lot of times you can set this up, especially pre-litigation, by authorizing a specific person on the board to, implement, a collections policy. So that way, when you send something to the attorney, you're not constantly having to get authorization to proceed with the next step until you get to the place where a foreclosure is warranted. And then the board would need to vote on, filing a foreclosure and proceeding from that perspective. You just want to make sure you have everything done, so that way, if they have an attorney, if they want to contest the foreclosure, you have all of your ducks lined up.
Excellent. Great point, Donna. And Joy being a powerhouse, she hit some serious points there that are very important. And I really do want to touch on that ledger comment that you mentioned, Joy, because I can't tell you how many times when we've onboarded, let's say, a self-managed community, and unfortunately they had gone through 2 or 3 accounting firms or whatever it may be, and the ledgers are not there. And that just creates a major issue. It's very difficult for them to understand that, what do you mean we can't collect the debt? And when we hand it over to the attorney, it's going to be obvious. You're going to say the exact comment. If we don't have all the way back to a zero balance, it's going to be very difficult for us to go to court and prove that that money is owed. And this kind of brings it back in full circle of the importance of the board really reviewing the financial statements every single month and understanding, okay, where is my AR? And if you have a balance, okay, do we have those ledgers? Because if you're working with a professional company, whether it be accounting firm or management firm, they're going to have those readily available, digital. They'll get them to you fairly quickly. It should be within a day of maximum, or you'll have access to them online. But yeah, those are very, very great point that you mentioned of having those ledgers, and also the adoption of the notices. I know in the past, in 11 and 12, I remember certain special assessments being challenged by the opposing counsel because notices weren't provided correctly. And now statute with time has changed, making certain requirements in the notices. So I'm sure this go around, they'll be attacking or looking for those holes in those notices to try to get their clients off from owing that. So there's a lot of administrative tasks that get done. That's important both for the managers as well as the board members on this call, that you're cognizant of it. And as Joy mentioned, that you're having the conversations with your attorneys so that the proper notices are done, so that, you're following your business judgment rule, and you could say, well, we had the attorney review it. This is what they recommended. And this is why we did it in the way that we did it.
What do you both do in terms of ledgers that need to be cleaned up? For instance, whoever is handling the inputting of data into the ledgers has added fines that shouldn't necessarily be there, or self-help costs. Maybe they've gone into a unit, they've done some work that the owner was supposed to and they didn't, but they don't have a self-help provision that allows it to go onto the ledger as a special assessment. Joy, what do you do to clean that up?
So, that honestly, that's the least hardest thing to do, because really all you have to do is take those charges out. right? So what we're looking for is a ledger that shows the assessments that came due and the payments that were received. Personally, because we don't necessarily expect that the management company is always going to have the correct amount of interest or even have late fees for every time that they can. That part we do in our office, but I will say what is concerning at times is if we aren't paying attention and there are other charges on the ledger, such as a fine, such as a self-help provision. Sometimes the payments that are made for the assessments will be applied to those costs or those fees, which is not allowed. A payment for an assessment is a payment for an assessment. You can't apply it to a special assessment, a fine, or another cost unless it's specifically for that, right? So there's been occasions that I've been reviewing, documentation, and I've realized actually this person is up to date on their assessments. It's really a fine or another cost that they owe. And I'm not saying that we can't collect those in a different way, but they're not the same thing as assessments. So in terms of cleaning up the ledger, the biggest thing that we're looking for is just that the assessments are on there and the payments are on there, and then we can, figure it out from there if we need to. And anytime that we see a fine on a ledger or a charge that's not an assessment, we always ask for backup documentation. So if you have finding documentation, then we're going to look at that. And depending on whether you're a condo or an HOA, if you're a condo, that's not going to become a fine. If you're an HOA, it's only a fine if it's over a certain amount. And then with respect to the charges that you were talking about, Donna, a lot of associations think that those charges can just go straight on the ledger and be collected as an assessment. Well, that's not really accurate. Even it's only if your documents allow for a charge like that to be collected as an assessment that you can collect them in that manner. In addition, even though your documents don't say this typically, we require that the association actually levy that as a special assessment or an individual assessment against the owner. And, when associations ask me why, I say, well, just because you can collect it in the same manner as an assessment doesn't mean it's automatically an assessment. You have to go through the process of levying it. So that way, if we go to court, which is what I'm always looking at, I'm always trying to build a case from the ground up as if we're going to be in front of a judge. The judge will say to me, how was that adopted? And I'll be able to say, well, they did a 14-day notice of the meeting where that was adopted. They gave the owner notice, they voted on it, and therefore here it is.
Yeah, I think people lose sight of the fact that foreclosure is litigation.
Yeah.
So you do have to build a case from the ground up.
Yep.
Correct. Yep, makes total sense. And I guess from the management point, Don, I mean, we've had to reconstruct certain financial statements if it's not too far back. Let's take 3, 4, 5 years. And a lot of that really depends on the access to the bank account where the initial receivables were being sent. Because if they no longer have access to the bank account, that bank no longer has those files, being those deposits that were done. It's almost impossible. In that case, we would probably recommend an auditor or someone more specialized to do it. But yes, we've had to reconstruct, especially in those messy situations. Whereas Joy mentioned, you do have two separate ledgers. Ideally, if you have a special assessment and a regular assessment, so you could manage that. The pro of that is it's easy to separate what's for A and what's for B. The challenge with that becomes when residents sometimes just want to mail one check and they don't understand the protocols of why we set these up in two separate ledgers, even though in our system we allow them to merge the accounts and make one check. They don't go through it, right? It's their process. We can't manage that. So that's where the challenges arise, because we send it to the attorney. We have two separate ledgers, and boards will tell us many times, well, just move the extra payment from ledger A to ledger B. And well, we need approval from that for the resident, because last thing we want is that wasn't for that. We made the adjustments. Now the books come to audit season. What are all these adjustments and all these entries for? And then it can look a little bit ugly. So this is where the importance, I say, of having the open communication with your management partner and your board of directors, so we can get away from that finger pointing approach of why did this get done. There's intricacies to it, because if you bring in, let's say, Joy or the team, your legal team into it, they'll give you the explanation from their standpoint of why these things have to be so meticulous. So many different challenges that we each have to deal with individually. And that's why we charge what we charge, and attorneys charge what they charge in order to do these collection processes, because it is sometimes, in some instances, pretty labor intensive.
One of the things that I would point out too is that, your commentary about sending in the checks, I think that associations really are doing themselves a favor and a disservice if they don't do this, is to offer online payments, but offer, automatic withdrawals.
That's right.
The more that you can push your community. I mean, I personally am a member of a couple of associations, and I'm set up on automatic, withdrawal. And when a special assessment got passed a couple of years ago, I didn't even have to do anything to update my payment. I got notice, and then it came out, and that's very helpful, because then you don't have to deal with the getting two separate checks, one check applying here, applying there, and I know not everyone likes to do the automatic online stuff, but if having that option, if you don't have that option, you're really doing yourself a disservice.
Yep, great point, Joy. Couldn't say it makes our lives much easier as well. About 83% of our residents are on some form of e-check or ACH, and it makes everyone's life easier. Cash flow helps for the association, and less collections as well.
Yes.
So let's switch gears here for a little bit. We have about 15, 20 minutes left, and I know there's an important topic that we need to touch up on, which is reserves and long-term planning. So I want to kick it now back to you, Donna, how should associations plan in managing the reserves effectively? And I'm talking more, I guess, from the legal standpoint, because I know you're not the accountant per se. So maybe if you could give some insight there.
Sure. Well, I mean, listen, if we're talking about condominium reserves, the board's pretty hemmed in by the statute. There's not a lot of leg room for them to roam when it comes to structural integrity reserves, which we know came about as a result of in the aftermath of the Champlain Tower tragedy. They have to get an engineer out if they are 3 stories or higher. And yes, there's, if you've got 3 units or less, I won't get into all the intricacies of the building, but basically, rule of thumb, 3 stories or higher, you're going to need to do a structural integrity reserve study. Couple different recommendations. One, there are some boards out there that are looking for peer reviews on these structural integrity reserve studies, or SIRS as we call them.
Mm-hmm.
That's acceptable if you're looking for a more robust study. Okay, if you think the first study didn't go far enough, maybe you have 180 balconies and the company only looked at 3, then yes, I'd say go get a peer review, get a more robust study. But if you're looking to kind of shop around and see if you can get a less robust SIRS so you can put less away, that's ill-advised. I will also tell you that I'm hearing from a lot of associations when it comes to the SIRS, when it comes to window and door maintenance, Raphael. So a lot of them will say, okay, currently under the documents, the association's responsible to maintain the windows and the sliding doors. Our reserve specialists may have told us that if we amend the documents and we shift that obligation back to the owners, now we don't have to reserve funds for windows and sliding doors. Well, as with most things in life, there's a consequence. And whatever you may gain by not having to put away money in reserves for windows and sliding doors is probably going to be eaten up by legal fees, chasing the owners who are not maintaining the windows and doors after you adopt that amendment. You may suffer some potential losses in terms of your insurance premium. If they come out and there's an appraisal and half the owners have not undertaken regular and consistent maintenance of the windows and doors, that is going to impact your appraisal, and it is going to impact your insurance premium. So again, I would say short-term thinking, take that off your list now. When it comes to reserves, and people should have been doing this all along. Can we just say that? They should have been doing this all along. Eventually there was going to be a bill to pay. So for the associations that all along, slow and steady, they put money away in reserve, they have fared the best. It's the ones now that are really struggling. And when you ask them, they went decades and there were no reserves. So there's not only are they starting from scratch, but they've had major repair and renovation projects they've had to undertake. Most of them has funded that through special assessments. Joy, I actually wanted to touch on what you said about special assessments, is to make sure you've got enough put into that special assessment, which covers, any field changes, soft costs, permits, legal, engineering, all the rest of it. Because what happens if you don't have that is you have to go back with another special assessment. And that's even, I just think from a pure optics and psychological standpoint, it's harder to keep going back with a series of special assessments.
And a lot of associations, especially when they're doing a construction project, concrete restoration is a great example. They'll often pass a special assessment that's a third more than what the contractor tells them originally. And the contractors will actually tell them to do that. And 9 times out of 10, they need that 1/3, if not more.
Yeah.
We'll add on that. I'm sorry, go ahead.
No, go ahead. Go ahead, Don.
No, I will add, so right now, a lot of our clients are looking at 2 pooled accounts, SERS and non-SERS, okay? But if you know your budget's going up exponentially, maybe you really scrutinize what you're reserving in the non-SERS. So, and maybe you scrutinize the aesthetic projects that are on the horizon, and you think to yourself, okay, our budget's going to go up because we need to start funding. This is mandatory. Maybe you give your owners some breathing room on not undertaking purely aesthetic projects right now. You always have to prioritize the life safety projects first.
That's right. And I think the key here is just that the communication of just hosting the town halls, and at least these decisions. It's not just sending a notice, just really explaining to the residents of why they're making these decisions. And then that's where the appreciation will come. Maybe not from all the owners, right? We all wish that, but at least for those that do attend. Because I know I have found it when you host those town halls and you give them an explanation, and nowadays with everyone using Teams or Zoom, it makes it a little bit easier. And you're able to disseminate why you're making these decisions. It makes it much easier. I know for the older condos that we do manage, that's how we were able to manage the SERS component. It's just, okay, they had some reserves, and where the focus was heavily is on, okay, how do we get the SERS up to the requirement that's necessary based on the report that was received? And that means bringing down the aesthetic components and taking the vote that's necessary to reduce those amounts. That's how we were able to manage it. But it's a difficult situation that we're all going through right now, or our associations, I should say. But the truth is that I think in 2 to 3 years, we're going to be in a much better position. Now boards are going to be able to make the right decision for the community rather than just upgrading lobbies instead of, fixing concrete restoration projects. So I think right now we're going through the thick of it. But within a matter of few years, it's going to make it much easier for all of us. And it's going to give residents the true value, or the true cost, I should say, of what it is to live within a community association, especially condo associations. And as you mentioned, Joy, that's a great point that you mentioned about the 1/3. I wish it was easily that said and approved, but it's not. But the truth is, you're right. Many times these contractors, it's not their fault. There's no way they're going to chip the entire building giving you a proposal. They just won't know. They take a 10, 20% figure, and then they assume that's what the rest of the building is going to be. Many times they want to blame it on the contractor, the engineer, something's going on in the back end. But the truth is, they only probably reviewed certain sections. If an association has the money, then they could swing stage the entire building early on, really get to the nitty gritty of it, and then get very closer to that cost. But unfortunately, that's just not how it works many times. So
please get your repair contracts reviewed by council first. A lot of times that 1/3 over it also includes incidental damages, which if your contract is properly reviewed and revised, that will be on the contractor. If you're doing concrete restoration and the contractor is damaging awnings or hurricane shutters or the windows or the doors, that can all be negotiated up front. But that means don't sign a boilerplate contract.
Correct. And that's the critical component that's missed. And it's you don't wait till you're about to sign the contract. You should already be having those discussions as soon as the project is going to get launched, just getting those discussions going on early. So we're coming up at the end of the webinar. I wanted to just give you both, I guess, one last question, and I'll start with you, Donna, is, how can boards ensure, that they're providing their residents with the transparency that's necessary, we have all the negative media that just never ends. But what are some golden nuggets that you can give them with regards to financial statements or anything else that would give these board members a little bit more sense of, or I should say the residents' transparency that's necessary?
Well, if transparency is the goal, okay, and proper governance, then you need the right people in the seats. You need the right people serving on the board. You need people who are serving on the board who understands what it means to be a fiduciary, which is to put the association's best interest in front of their self-interest. It also means people who understand that there's some tough decisions to be made. We've been talking about this for an hour.
Mm-hmm.
If you have candidates running for the board and they're running on a platform of, I'm going to reduce the assessments. I every time I hear that, I think of like the people back in junior high and high school who were running for the student council and said, I'm going to get us all free ice cream on Fridays. And, I was the skeptic, always thinking, I don't think that can do that. It's the same thing. This is why also when financial information goes out to the residents, read it. If somebody's telling you, a candidate for the board is telling you something that seems too good to be true, it might not be true. So you have an obligation as well as a member of the association to understand what the financial picture looks like. And then lastly, I would say not only having the right people serving on the board who understand what it means to be a fiduciary, is having those people hire the right professional advisors. If you've got a good board working with good professional advisors, you're going to be much better off.
Excellent. Thank you so much, Donna, for those great golden nuggets. And Joy, I know you gave us a ton, but any last nuggets that you could provide to our listeners today?
So it's never too late to get your, financial house in order, right? So you might have a really high delinquency rate, you don't have a collections policy, you don't have a standard way of operating. Do it now. Do it now. So talk to your counsel about it. The collections policy does not have to be a complicated thing at all. Just set a time frame for when you're going to turn accounts over to or send that first 30-day notice of late assessment and then send it to the attorney, so get that in order and just let your owners know that you're no longer going to tolerate, the amount of late payments that you have. I mean, we had associations, I've done this many times with many associations that have come to us with a very large delinquency problem. And within 6 months to a year, we've gotten it under control because their owners realized, oh no, they're serious. They're no longer going to let me do this, right? And that doesn't mean that everybody pays, but of the vast majority of them do. And the vast majority of people pay before they lose their home in foreclosure. So, even if you have to take it all the way to the end, don't wait around. Don't wait for the bank to file a foreclosure. If the bank does file a foreclosure, talk to your attorney about what that means. But, the biggest takeaway that I would say is simply don't wait. If you haven't been doing it, do it now. If you are doing it, keep doing it, So just make sure you have a strategy for not letting those delinquencies get out of control and be willing to work with your owners. If you have owners that have fallen behind and they want a payment plan and it's reasonable after you speak with the attorney and there are, ways to protect yourself, which there are, you don't give up any rights by settling with someone because if they default, you can always proceed, so have a plan. Implement it and stay the course.
Excellent. Thank you so much, Joy. I think I want to piggyback off the plan. As I opened the webinar, I mentioned about vision. It's for our board members, it's just really to have a clear understanding of what you're going to do as a board, like what are your goals so that you're aligned. And as Donna mentioned, of having the right people in the right seats, the only way you're going to know that is knowing by what your objectives are going to be. And do you have the partners around you to be able to execute on that particular vision? And making sure that you're not waiting till the end of the year to say, okay, we're behind or XYZ, as Joy mentioned earlier, is just checking in. If you're doing the process, continue the process. If you're not following the process of where you are with your goals, then just ensure that you need to start immediately. So I think more than anything is making sure that as a board, you're delegating so you can elevate. The focus shouldn't be just on you. If you have the right partners, they're going to support you. I know there was a comment in the questions that, well, when we contact the attorney, there's always an expense. Yes, there is. There's an expense for it because they need to do the work that they need to do, no different than management. If we're having to get involved, something that's outside of the scope, then yes, we do need to charge. But again, if you have the right partners, the charges so that you can get closer to the objectives that you have. So outside of that, I do want to thank you both for being with here on this webinar. I hope our listeners and our viewers were able to get the value that they were looking for. Thank you, Donna. Thank you, Joy, for being here. We'll have the video up on our YouTube page within probably next 24 hours. So we hope you enjoyed the webinar, and we'll see you in the next one.
Thank you,
Thank you all.
Rafael.
Thank you
Thank
very
you.
much.
Thanks, Joy.
Bye-bye.
Bye-bye.